think it's something that we should remind people that it ain't going to just keep going back up because it went down. There could well be some significant issues still in front of us.
It's a great point, Peter. Like, you know, I'm doing my head in on this, trying to sort of think about, you know, what the next step sort of looks like. And the thing that kind of, obviously we know, you know, the economic outlook looks horrendous, but that's not necessarily indicative of the market. And, but the thing that I find quite concerning is a lot of the investors that I really respect. So MFF Capital, Chris McKay, who I rate as one of the best in Australia. So MFF is now 43% cash. Now he's been 100% or more than 100% pretty much for the last decade. And he didn't go to cash pre-COVID. He went to cash at the height of COVID, you know. So, you know, there's that. And then you've got Buffett, who, you know, hasn't deployed the cash yet. And then there's guys like Stan Druckenmiller and, you know, so there's all of these guys. But then on the other side of that, you think, okay, well, when all of these funds are running more cash, basically running the maximum amount of cash that their mandate would typically allow, and you pick up the paper and the paper's bearish and all of that, and you think, okay, well, how much does the market actually fall? Because it feels like everybody is positioned for it to fall. So everyone's sitting there with all of this surplus cash. So it's really, yeah.
I think Peter and I have had that exact conversation with a few clients where we sort of just, you know, talking both ways on it with them and saying the same thing, that when, you know, everyone's views the same and everyone's sitting on cash, eventually their cash is going to eventually have to go somewhere. Like, and that's sort of why the market, you know, back previously, some of those stocks had run up because people go, oh, interest rates are shit, I need to get my money doing something. Just go and park it in something like ASX or, you know, Transurban or something and get some income out of it. So be interesting. You know, time will tell. But if everyone's on the same, everyone seems to agree it's going to go backwards, but that's not how the market works. Like, that's just not how it will happen. Can, but yeah, it's interesting.
You're just on mute, Pete.
I had a Nutribullet machine going in the background, so I turned it on mute, forgot. Everyone is predicting it to go backwards, everyone's waiting for it to go backwards. Well, it won't do that because that's not the rational way. That's not the market. It's an irrational beast.
That's exactly right. And you just, I mean, use MFF just as one example, but multiply that across the whole, you know, professional investor universe, that they're all sitting there with this cash going, if we get a pullback, I want to deploy that. So, you know. And actually, I mean, I think just one little interesting anecdote. So you saw yesterday about news about US market was obviously up over 4% on news that, you know, now this vaccine is like, this is still a long way off, but you can see the slightest whiff that there is kind of light at the end of the tunnel. The market is just ripped. So,
and then this morning I wake up and the headlines like, oh, concerns over vaccine, and the market's down by 2 or something. Like, it's crazy.
Beyond the current pandemic, longer term, you know, there's these questions around inflation and, you know, deflation and, you know, all of these things that are very complex questions. And what does all of that mean for, you know, which asset classes are going to be the best performing? And I think at the end of the day, all you can do is just be diversified across all of the major assets. And you know that you're going to be okay on average, you know. And
come on, Hamish. People don't want you to sit on the fence. People want hard. They want the stock to buy at the right time, at the right price. That's what you're here for, mate.
That's it. But you know, the argument for a diversified portfolio across, you know, shares have to be part of the picture, and, you know, property has to be part of the picture, and cash has to be part of the picture. But the argument for that, I think, is as strong as ever because of the level of uncertainty. I guess, you know, I'm sure you guys agree. How I've been thinking about that is, as you were sort of saying, with JobKeeper and JobSeeker, you know, there's a Band-Aid on it at the moment. No one's being forced to sell anything. But in 6 months' time, obviously, if you're not able to make your mortgage payments, the bank is eventually going to tap you on the shoulder and say, okay.
Sorry, son.
Yeah.
So either things improve between now and then and it's all okay, or they don't and it gets messy, I guess.
It will probably, things will improve, but will they be improved enough to sustain all of those mortgages? People we've seen it borrowed at 90, 95% and their interest rates are shit, but now their property value goes down so they can't refinance it because the valuation won't stack up, and then they're stuck at like 4 or 5% interest rates, which are terrible in today's dollars, but they can't do anything about it, and it's a cycle.
Yeah. Just one other thing which I think reflects, I'm pretty sure you can answer this, I'm sort of speculating on how those shares you buy for us, for our clients, but the sort of bits and pieces you read and listen to, the values of the really big blue chips are not necessarily super cheap at the moment. So where we might get much better outcomes are by not just going and buying the stock standard 10 or 12 massive, like the big four banks as an example, but go for the mid caps, the sort of the medium businesses, the ones that are not in the top 20 or the top 30 or the top 40, where there is a bit more upside over time. And, again, can you talk about what you do with us? And I think, like the likes of Future Generation and others, you wouldn't consider them to be ASX top 20 stocks, would you? I mean, would they be in the top 100? Would they be in the top 200? Where would they sit?
Yeah, no, a couple of, I think this is such an important thing. And again, this is a big issue that I'm thinking about a lot. But to your final point there, the Future Gen Australia is particularly skewed towards sort of that mid and smaller cap end. So if you contrasted Future Gen Australia with, say, an AMCIL or, the underlying, the positions that we own directly for your clients, Future Gen will generally have more of the other stuff in there. So that's one of the reasons why we like it. And again, it was probably a reason for some of the underperformance that we saw last year. So yes, I think that my sense is that some of this sort of smaller, so essentially what's happening, and this is even more pronounced globally, is anything, it's this growth versus value type of argument. So any business that has strong revenue growth doesn't necessarily need to be profitability, but anything that's actually growing revenues has just gone up and up and up. Whereas anything that is perceived to not be growing or going backwards, valuations have just been absolutely smashed. And so growth versus value as a style, growth has absolutely destroyed value to an extent that we've never seen. And so, in Australia, I guess the poster child would be a CSL versus, a bank or any of these more cyclical sort of businesses. And CSL, obviously, its earnings have grown over the last decade, but the price relative to earnings has grown even more considerably. And so CSL is an amazing business, and it looks like it's going to continue to grow its earnings at a reasonable rate, but it's also on a huge valuation. And so
Harbour spend $300 and think it's going to grow lots.
That's it, and so I think it's trading on about 40 odd times earnings, right? And a lot of the businesses that we would own for you would be somewhere between kind of 14 to 20 times earnings. So if that perception of growth ever changes, then there's a big sort of difference there. Yes, and then so if you get this economic recovery, then maybe these more cyclical businesses, take an Origin Energy, for instance, where it's obviously struggled because the oil prices time. But if inflation was to come back, you would think the oil price goes up and Origin would be then extremely leveraged to that. It's difficult. I think the answer is that's why having future generation in there to give us exposure to that sort of stuff, combined with quality businesses that we want to own for the long term, to me, that feels like a good combination. The thing, say, a Warren Buffett would talk about, and this is what I'm trying to do as much as possible, is if you can own a business that generates good returns on equity, so every dollar, if the business makes profit, if it retains that profit and goes and invests in a new product or factory or something, if it can get a good return on that reinvestment, a 15% return on its investment or a 20% return on its investment, that's the thing that adds value over time. And so I guess think about a Ramsay Healthcare, which we're obviously putting into portfolios at the moment. If it can retain its earnings and it can reinvest those earnings in a new hospital, and that new hospital will give them, a 15% return on capital that they're investing, and then they can just continue to do that, then that's a really attractive business. And over time, the investors' return, the shareholders' return should reflect the return that business is getting on the capital that it employs.
Hey, Hamish, just a quick one before we wrap up. We've got a 10 o'clock one, but a couple that you had for me a month or so ago, internationally, Visa, which you said at the time is, sort of pretty well placed in the current environment. How do you feel with the likes of those? I mean, the thing that I keep thinking about just how heavily leveraged everyone is, and how it's sort of sitting beneath the waves is this picture of just how much. I know it's visible because they've got statistics on what sort of personal debts people are carrying, but I mean, I continue to think about that. Just how heavily leveraged people are, and if we are in a position where, as Ben mentioned earlier, we have even a marginal increase in rates, and even if employment does come back, it's worse than it was previously. That it feels to me like there's this brewing new credit crisis that has the opportunities to swallow things up and obviously cause a pretty big ripple effect. And I mean, that's probably the thing that up until now you'd suggest that we haven't seen is a freezing of credit markets or a real damage to credit markets. But I don't know. That's why I've just been thinking about that lately, thinking, and I'm even looking at some clients I know probably domestically where probably not as, I don't know, I don't think we're as highly leveraged as maybe those in the States, but still I look at some clients and look at the extent to which they've extended themselves, and it's a concern.
Yeah, and your I guess your inference there is that Visa, the credit risk, if people start blowing up, then does Visa cop the credit risk of that? Yeah. Okay, so
the long-winded question.
No. But this is a really important, because I didn't kind of understand this. It took me a while to kind of get this, but Visa doesn't actually issue the card, so the credit risk doesn't sit with Visa. So if you go to your bank and get a credit card, it's actually the bank that issues the card, and so the credit risk sits with the bank.
Yeah.
So all Visa and MasterCard do is they have the infrastructure that enables the shop and the bank and the customer to transact over this. Essentially, think of it like a toll road or a railroad.
Yep.
They have the infrastructure. So if you go out and borrow $100,000 against your Visa card and then don't pay it off, Visa obviously clips the ticket as you're spending that money.
Yeah.
But if you don't pay off your credit card, that credit risk sits with the bank.
Yeah.
That's why it's such an attractive business. And so basically,
risk.
That's it. And so they get about it's over a 40% return on investment. So as they retain money, they get 40% return. It's just amazing. It's this compounding machine, and there's not a lot of risk. But the only risk is if there's some technology that comes along that changes this whole game. But every time you transact online, or you do your pay wave, or you use your phone they click the ticket. And
I didn't fall off my chair today, Ben. So.
Yesterday we finished one of our meetings, Hamish, and Jay and I were sitting there talking, and then his face, I heard the crack of the chair, and then his face just as he rolled straight back off it, just bang.
This kneeling chair, the seat came off it, and my laptop flew this way.
Just thump as he hits it, and the laptop flies up. I wish it was recorded.
Yeah, it was pretty disappointing that we didn't record it.
As you guys would know, we were just doing some term deposit. Leanne was rolling some term deposits yesterday, and she said she sent through the rates and said, what should we be looking at? And obviously the major banks are looking at sort of 0.6% or something. And
it's insane. Yeah.
That's kind of why the market's going up, right? When you look at all of the issues that are out there, I guess all you can say is thank God interest rates are where they are as far as equities.
It's certainly helping. I was reading some stuff last night, and this incredibly low interest rate environment. People have got to find somewhere to invest that's going to give them a reasonable return. You're better off to take a risk with a share that pays you 4 or 4.5%, rather than lock it in for 6 or 12 or 18 months at 0.6.
I mean, have we? Obviously, we're at historical lows, but looking back at some of the bear markets of history, Hamish. I mean, have we ever had anything close to an interest rate environment like we're in at the moment, at the same time as a market decline? I mean, have we got something comparable in history, or not?
Maybe the Depression.
Oh, Hamish is frozen. Sorry.
He's frozen in Portland.
Yeah.
Telstra.
You've really blown him up with that question, Jay. Questions out there.
He's considering deeply. Look how deep in thought he is. Well, you were there in the Great Depression, PB. What were interest rates like in the Great Depression?
Well, I can't quote facts, mate, but my understanding was that if you look back, and if we did do that research, I reckon that interest rates would have been incredibly low. No one had much cash, and the banks would have been just basically stockpiling money, so it would have been difficult. Hamish, back with us, mate.
I'm back. Sorry, guys. It's
no, we just made fun of you while you were going. It's all right.
Jay, what were you saying? Sorry.
I was just talking about any comparable situations in history of interest rates being at such low levels and a market being at such low levels at the same time. And so I just asked Peter, because he was around in the Great Depression, we just asked him what interest rates were back then.
Very good. Very good.
Yeah. I mean, is there a comparable point in history where we have, the cash rate and the market at such low points? I mean, is there some data on that, or not really?
Yeah, I know, like interest rates. So interest rates within Australia have sort of never been this low. Now, globally, there have been periods in time, going back a long way, where they have sort of been this low. I don't know where valuations of equity markets were back then, but equity markets were.
Peter?
But what was I going to say? I mean, I think that if you could suddenly flick a switch and the economy was back to where it was, say, at the end of last year, then you've got
Finish your sentence for him, Peter.
Yeah,
He suddenly got.
He's back.
Go again, Hamish.
Yeah, I was going to say, if you could suddenly flick a switch and the economy was back to where it was at the end of last year, you sort of got the perfect setup for a bull market in that inflation's low, interest rates are low. If the economy's okay, then, you know, money's got to find a home. And so, you know, I think markets are going up as everyone's sort of thinking about this economic recovery, with interest rates being so low. But then on the other side of it, you know, how bad is the...
Yeah. So I suppose the question is the cash money finding a home too soon? Like, is it rushing in? It's probably to our point of many of our other conversations about saying, well, we don't know, and trying to spread that risk over time, because, you know, going all in because the cash rate's shit is probably not the right answer. You know, it might be with the benefit of hindsight, but without the benefit of hindsight, mitigating risk is a really important consideration.
Yeah.
I think it'd be a look back on the market over the last probably 4 or 5 years, Hamish. We've had lots of conversations about, you know, things weren't growing massively in the economy, but because rates were so low, money was still finding its way into the market in that sort of bond proxy, I think, as you'd sort of termed it. You know, the ASX or like those sort of stocks that are, you know, pretty vanilla, but they were just paying a higher return, even the banks, I suppose. Is that sort of where people are probably flooding back into again now? Is that sort of line of that really blue chip, sort of boring stuff, or is there a bit of other things going on as well?
Yeah, I would say that actually, just in the last
Just whenever he's about to say
month or so, the things that are going up. Sorry, it's cut out again. Yeah. So I would say generally, some of the things that were really flying during COVID. So if you take Woolworths, for instance, as people were stockpiling toilet paper, the price of Woolworths was skyrocketing. Woolworths has actually come back quite a lot. CSL was another example as well. So I would say that just in the last month or so, the things that have really rebounded hard have perhaps been a bit more cyclical, or, you know, things that have been sort of more exposed, more hit from the COVID issues.
Yeah.
Which is interesting, though. You know, I think that, you know, take Woolworths as an example. It's probably getting back to a level now where, you know, it's basically the same price as where it was sort of a year and a half ago. It's obviously going to be pretty resilient, whatever happens with the economy over the next couple of years. So, yeah.
Is the risk for those ones that, you know, we're talking about, and I'm looking at a couple that we've spoken about where they might own, you know, exposure to cinemas, or they might have, you know, ski fields, or, you know, like accommodation and things like that. Yeah, is the risk for them they get this run on and then there's a shutdown or something like that, and they sort of fall through the floor again? Is that the real, you know, they're sort of really wound up with risk from where I sort of sit? But
yeah, exactly. So I mean, I guess the classic examples would be, say, Flight Centre and Webjet, that are sort of right at the pointy end there, or even Qantas, I guess. You know, Flight Centre and Webjet have been rallying in the last couple of weeks. I guess people are playing that recovery thematic, but obviously, yeah, if you continue to get these sort of lockdowns, then those things will be impacted for some time to come.
Even the suggestion that some of this excess money that didn't get spent might now be fed into the tourism and hospitality type areas to assist them to recover. That doesn't guarantee that they're going to get through. You know, they might have support for 6 months, but on the other side of that, what's going to happen? And the government can't continue to support them forever. So the markets jump pretty quickly on a speculation that will make a big difference. Yeah. Is that sustainable? Who knows?
Yeah, that's exactly right.
this might be stretching a long bow. So I don't think we have any exposure directly, I'm thinking. But some of the real estate trusts that own a lot of, office space and things like that, is there any, this might be completely just not something you looked at or thought about, it just sort of popped to my mind that a lot of people you talk to are saying about the offices that might not get used as much. Is that an area where there's going to be some real upheaval and some risks associated with that? I think Arena maybe is one that we have used in the past, is probably more childcare based from more doctors' offices, a bit different, but the office space, is there anything on that?
Yeah.
He's very considered with his responses this morning, isn't he?
Every time he starts to talk.
Yeah, I bet something's going. So the retail and office REITs got smashed. Retail in particular, as you would expect. It is interesting though, watching the price action on some of these things in the last, and I guess it's playing this recovery theme, but some of these things have actually started. So like Vicinity, which owns Chadstone, and so it's actually had a really strong week or so. And I went to our local Westfield here in Bondi 2 days ago, and it was busy. I was really quite surprised. And
what were you buying, Hamish? No new ties, obviously.
I was at the Telstra store.
Complaining.
Yes, exactly. So, but it's good to do that, right? Because you suddenly think actually people are going to continue to get on with life. Like it's a nice reality check to actually go out and sort of see what's actually going on in the real world.
Yeah, I felt the same way when I think it might have been the Mother's Day weekend, and even since then. I don't go out that much, but Mother's Day is about the only time I go and shop because I have to. But it was business as usual largely, other than some wash your hands before you go into the shop. But people are out and about. People are out and about making use of all of that. People want to get back to normality. I think probably, as Ben said, that I have this sort of, I don't know whether it's just it's a suspicion or just it's sort of it's a bit of confirmation bias there around how we're working from home. I think about all those people going into the CBD. So that's probably the big CBD office buildings. Like beforehand, they probably pushed against having their staff work from home. Said we don't have the infrastructure. Now within 2 weeks, they've had to have the infrastructure built to be able to work from home. So what is the flow-on effect, if any, to sort of commercial property? And I suppose to Ben's point, is that a risk? And then are we exposed anywhere in our portfolio to that risk if it exists?
Yeah, certainly within the direct equity positions that we have for you guys, we don't really have any office exposure. I think you've got quite a bit in the AMP Property Trust, don't you? So I'm not sure what the underlying exposures there are. But
we have a bit of Arena, but I think if you maybe just touch on that, I know clients have it, some probably know what it is, but
so Arena so Arena primarily owns the physical properties that are leased to childcare centre operators, and so it's a very well managed business, and has probably been in a growth area in terms of childcare centres. It's done exceptionally well. As you're probably aware, we have trimmed some of those positions over the last year or so, just because valuation got pushed pretty hard on the back of falling interest rates. But the price of Arena got smashed initially with COVID because there was the concern about how many of these childcare centre operators would not be able to make it through. But subsequent to that, with the initiatives around JobKeeper, and there was specifically childcare support packages, and so the price of Arena has actually started to recover, and it's actually been really strong in the last week or so. yeah, again, I think along with that thematic of, how do you sort of play that recovery? But, look, I haven't looked at the specific numbers of Arena in a little bit, but, the price is actually, it's sort of well down on where it was pre its peak. So it's sort of, it's probably back to more reasonable levels now.
I suppose in my mind, I think of that being a bit more of an essential thing that, you can't remotely look after kids in childcare, whereas we can remotely work from the office. So it's not like they're going to just say no more childcare centres, everyone keep your kids at home, turn Zoom on.
Can't you look after your kids remotely? I've left them at home a couple of times. That was a joke.
Oh yeah, sure. Put a disclaimer on that.
Yeah. Hey, I'm sorry, we're going to have to wrap this up. I'm getting heat from my wife to give up the office so she can run her online business via Zoom. So we might need to call it quits. But yeah, thanks again, Hamish.
Sorry to be late, guys.
So, I mean, one of the things I've been thinking about is
maybe we should ask Milo if he's got any.
Yeah.
The Oracle of the Rubix might give us information of anyone as to what's going on.
Yeah, I mean, it's extraordinary, right? One of the things I've been thinking about is how much time I've been thinking about the direction of the market over the last few months, and it's just it's a wasted exercise to a certain extent. At the end of the day, none of us know in the short term. We know over the long term, markets are going to do well.
Last time we were talking about Berkshire and Buffett and his cash holdings. Has there been any movement on his cash holding that he's sitting on?
Nothing that I've picked up. We don't see information about buybacks or anything like that still for the next quarterly report, I believe. So they may have bought back a lot of stock, maybe. But yeah, bottom line is we haven't seen, the market hasn't sort of picked up on any significant moves from them. The other one, which I find even sort of more extraordinary, is MFF Capital. So they have almost 50% of the portfolio sitting in cash now. So basically, MFF Capital is Visa and MasterCard with a bit of Home Depot, and then the rest of it is almost all US dollar cash.
They sold about a month in, or a month into cash, did they not?
That's right. Yep. So that he was sort of selling, mainly through April, really, and a little bit in May. So he's missed a significant part of the rally. Now, for me, that's not an issue at all. That's, he's got the direction of the market wrong after an exceptional long-term track record. And I'm very confident he'll deploy that cash at some stage, whether it's in a year or something, at some stage he'll find a good home for that. But it's just really interesting that, a guy like that, who I would regard as probably the best investor in Australia, has been completely wrong-footed. So
is that why you'd say that they've sort of lagged the market recovery? They've just hovered really at the same point because they haven't got as much skin in the game.
100%, Ben, you're spot on. Yeah. So that, and I think ideally, I would like to see the price of MFF sell off and you might see that because some investors might get frustrated with the level of cash that he's holding while the market's rallying. And if that were to happen, if the price sold off and then the discount to net assets started to become wide, then that would be an outstanding opportunity. But you're right, the price has it. And in fact, his assets in the last week, the net assets have come down in value a little bit because it's all US dollar denominated while the Australian dollar has been rallying. So that has reduced the net assets. So net assets as of Friday night, I think were just under $2.90 and pre-tax, and the share price was just about $2.80, $2.81.
So what should we be loading up on at the moment, Hamish? Give us a couple that we should be adding to that look pretty good.
Yeah, so to me, in the SMSF accounts, a really sensible low risk one for me is FGG, Future Generation Global, just because the discount relative to net assets is still really significant. So because global equity markets are rallying, share price of FGG has gone up, but still there is a very wide discount there. So I think that other sort of single name companies that I think are reasonably priced at the moment. Brambles is a defensive business. They're sort of aggressively buying back stock, and it's sort of reasonably priced at the moment. So that's one that we're sort of very happy to be buying at the moment. Ramsay Healthcare is sort of in a similar basket there. And then, you know, we sort of had been starting to buy some Macquarie, which is more leveraged to the recovery, but obviously prices have sort of started to move in those types of stocks pretty quickly. So I guess you've got to be careful not to chase those too much.
Yeah. One I've noticed that a few clients have holdings in this from long-term holdings in CSL, which has sort of hasn't kicked back with the market. Is there, just for those clients that have that one, is there a reason why that's held off?
Yeah, now I think there was some news out on that yesterday, which I'm not up to speed with. I think there might have been some news about plasma collections being down, which may have been related to COVID, and that's maybe why the price sold off. I haven't read that news yet, so I've got to get up to speed with that. But I think that during COVID, its price was very strong because of the perception of it being a defensive business. And what you've seen in the last month or two is it's tended to be those more cyclical sort of businesses that have benefited from sort of the lockdowns being eased. And so, you know, CSL perhaps hasn't participated in that more cyclical rally. But yeah, I mean, it is what, you know, again, it's a phenomenal business. Obviously, the pricing of it has been very expensive for some time. So ideally, it continues to be weak, and that's one that we definitely sort of look to start putting into more portfolios. Basically, you can simplify businesses as growth versus value. And so say a growth stock, CSL would be the poster child of growth. Its earnings have been growing, or its revenues and earnings have been growing strongly. So that's great, but then the issue is that means that the share price relative to its earnings becomes very expensive, whereas a value stock isn't necessarily growing earnings, and because of that perception of lack of growth, that its price is cheap relative to its earnings. So those two different styles tend to cycle. Growth stocks do well for a while, value stocks do well for a while. Over the longer term, value has actually done better than growth because basically people end up overpaying for growth, and assuming that growth will continue forever, and then competition comes in or whatever. Whereas value, people tend to be too pessimistic about the outlook, and then actually things aren't as bad as what they thought. So those things tend to cycle. But what has happened since the GFC, growth has absolutely smashed value to an extent that's never happened before. And, you know, there's lots of explanations for this. It's difficult to know, but I guess coming back to your point about CSL, you know, it is definitely in that growth camp. And so, yeah, I think you do need to be careful not to just simply overpay for it. I think the free cash flow yield of CSL, if you actually bought all of CSL and you owned all of the cash that CSL generates, it's probably on about a 2.5% free cash flow yield at the moment. So if you compared that to a risk-free rate, bond yield of say 1%, then 2.5% looks attractive versus the 1% bond yield. But that's not cheap versus say a bank, which is on almost a 10% yield. And so the answer is, so long as CSL can continue to grow those earnings at a reasonable clip for the future, then it's probably reasonably priced. But if that growth ever stops, then that's expensive relative to other things.
What is that yield and banks is probably just flowing into that. Obviously, the banks have had a pretty significant bounce in the last fortnight, 3 weeks. What's driven that really? What is it? Just the fact that people have got money sitting around and they're just looking for income, which we've sort of spoken about in the past, or?
Yeah, so I think the banks have very much been one of the major participants in this cyclical rally. So obviously, in tough economic conditions, as we've spoken about, the bank's earnings will take a hit, and so the share prices got really smashed during the lockdowns. But on the other side of it, as people are sort of starting to think, actually, well, hang on a minute, the economy may not be as bad as what we thought. Life is sort of getting back to normal. Then, you know, the banks have been an interesting way to play that cyclical recovery. And I just think institutions, you know, they pile into and out of these things, and banks make up such a massive component of the index that if the banks start going up and you're a fund that is underweight the banks, then you're underperforming the benchmark, and so you feel the pressure to go and buy the banks, and it becomes this self-fulfilling sort of thing. Yeah. But you know, I think how I think about it for your clients is, you know, I think we've spoken about it before, that the banks, they're now probably trading at slight premiums to book value. That looks very reasonably priced relative to where they've traded historically. And, you know, it's not unrealistic to think that that simply translates to a sort of a 10% return for investors over the longer term. And those prospective dividend yields now are probably down to sort of about 8 or 9% grossed up. I haven't checked closely in the last week, but it would be something like that. Yeah. So, I mean, I think the starting point, what we try to do for your clients is construct a portfolio of businesses that we can own for the longer term. So, you know, that is very much the focus. Now, in saying that, yes, I spend a lot of time looking across the entire market. But the challenge with a lot of these smaller businesses is that things can change very quickly, and you know, so prices can be very volatile, you know, if something changes for the worst. What I would say is, if you look at Future Generation Australia, FGX, if you look at a lot of the managers within that, most of those are focused on sort of the mid to smaller end of the market, which is where historically the outperformance, the juicier returns have come. And so how I've broadly thought about that for your clients is that's a really cost-effective, low-risk way of getting broad-based exposure to that more mid, smaller end of the market. So within that, you know, within that, you know, there'll be the afterpays and all of those sorts of things will be making up positions within Future Generation.
Got anything for us? We can go and put $1,000 in and sell it for $1 million. What's the next CSL? Give it. Jay just wants something to go and drop a couple of dollars into. That's what he really wants.
Yeah, it's amazing how many clients, as much as you know, we talk about that core portfolio. Everyone has that sense of wanting the big ticket, you know. Yeah, but I suppose it's the gambler in all of us, isn't it? That wants to put it all on double zero in roulette and have it come up. But anyway, it's I'd be lying. I'd be lying if I said that I didn't think about that myself and where those sneaky opportunities lie. I know they're probably they're the exception as opposed to the rule. But those exceptions, like everything in life, get all the attention, and there's a bit of a survivorship bias there because you only hear about the ones that have done exceptionally well, and the people that have done poorly, which is the conversation we have with our clients, is that you don't hear about the 95% of failures. People are very vocal about the small percentage of those very high risk opportunities that turn out, but they're the exception rather than the rule, which brings us back to why the core portfolio and stability and that conservative nature should be the cornerstone of what we do.
They're all great points, and I always love the example. If somebody had the foresight to buy Amazon in sort of the late 90s, obviously they just would have made ridiculous amounts of money. But then the challenge would have been holding that position all the way through, and there would have been multiple times where Amazon would have fallen greater than 50%. And each time it's growing, it's becoming a bigger component of your portfolio, and so it's great in theory to say, I could have bought this thing at $1 and it's up 100 times, but trying to do it in practice is another.
You look back over 20 years without emotion, whereas when you're in it, you're flooded with the emotion of having to make those decisions. Where how many people would have held their initial
And I think, at the end of the day, coming back to your clients, what you're trying to sort of minimize, it's about managing risk, and we know that owning a portfolio of good businesses over the long term is going to generate solid returns, but you don't want to be too concentrated in any one particular thing. Otherwise that can, blow up the portfolio.
We're going to have to call it quits, guys. We've got a 10 o'clock Zoom meeting with the team. Thanks again, Hamish. And next week, I've actually got a bank of recordings have been slacked the last 2 weeks, and so there'll be a bunch going up today. I've got a bit of time. So thanks again, Hamish, and we'll see you next week.
See you guys.
See you. Back soon, guys.